Good morning, everyone, and welcome to our DATIQ weekly market update. This is our post-Turkey edition. Everyone's up a pant size. Hopefully everyone's doing well. It is November 28th, 2023. I'm Ken Adamo, Chief of Analytics over here at DAT, joined by Dean Croak, who's our Principal Industry Analyst, and friend of the show, recurring guest, Ibrahim Bayan, joins us this morning from sultry Atlanta, Georgia, I hear.
It's still pretty cold here today. It's like it dipped below 40 degrees, which is freezing in Atlanta terms.
I know I don't know. I can take the snow. I can take all this. This is bitter cold when the bottom drops out. You know, you have young kids; they're all instantly sick, right? Like all four of them to the hour. Like when that temperature dips 20 degrees, it's like just order the amoxicillin. Like just have it on speed dial, like dial it up. But Ibrahim, you mind giving a quick intro for folks who may not have caught you on previous episodes?
Yes, my name is Ibrahim Bayan. I'm the Director of Industrial Research here at Nuveen. So our company sort of owns and manages all different kinds of commercial real estate, but my focus is on industrial, so warehousing and logistics space. I've been in that industry in commercial real estate on this side for the past 3 years. Before that, most of my experience was on the trucking and transportation side. I worked at UPS for a number of years. Worked at Freightways for a couple of years, which is how I know Dean, and that's what brings me here.
Awesome. Thank you for joining us this morning. We'll bring you back in a few minutes. We're going to jump into our market update and then bring you back for the question of the week. So hang tight. We will be right back. Okay. So what's going on out there in freight? Busy week last week with the Thanksgiving holiday. So spot market line haul rates up as volumes drop on a short week. They're probably only 2.5 working days last week. If you think about it from a freight perspective, where shippers were out there really receiving freight. Dry van active contract rates up 5.3%, replacement rates down 4.3%. Replacement rates for all but intermodal are low single-digit negatives. The ATA truck tonnage index improved slightly in October, up 1.1%, but still down 3% year over year. And then we have our retail diesel prices continue to fall, giving spot market carriers a little breathing space. One little interesting note that came in after we put the slide together, ran some just comparative analysis on last week, and it really comes in how you'd expect. It's really in line with the down years that we've seen, 19, 15 and 16, but certainly underperforming 17, 18, and 22. So right there, square in the middle, is I think how we'll size up last week, at least looking at it less than a week out. So Dean, I'll bring Dean in to walk us through our longer market update. Dean?
Yeah, thanks, Ken. As we'd expect last week, a short work week, volumes down substantially, but in line with other pre-pandemic years. Certainly load-to-truck ratio and dry van sitting at about 1.60, fairly low compared to historical norms. In refrigerated, load post down substantially last week. Produce volumes are lagging even last year, which was not a fantastic year. Load-to-truck ratio sitting at about 1.87. And in flatbed, again, dropped in line with seasonal trends during the Thanksgiving week, sitting at about half what we'd normally see this time of the year. Load-to-truck ratio just over 4 at 4.06. Having a quick look at some of our markets, we'll have a look at the top 5 markets in dry van, tracking very closely when you look at California, Georgia, Illinois, New Jersey, and Texas average spot rates, sitting about 6 cents a mile higher last week at $1.75, very, very close with 2019 levels in the top 5 states. Atlanta rates up 3 cents a mile to $1.39. Lakeland and Miami is a very busy lane. Lakeland and Miami, very busy lanes out of Atlanta. Carriers paid on average $2.62 and $2.07 respectively. Remember, these are line haul rates excluding fuel. In refrigerated, Atlanta outbound rates up 12 cents a mile last week. It's a big distribution market. The high volume lane, one of the busiest in the spot market, is Atlanta to Lakeland. Carriers average $2.94 excluding fuel. That's the highest since February this year. On our ratecast forecasting tool, spot rates on this lane are forecast to increase another 22 cents a mile, ending at about $3.16 by the end of the year. Twin Falls, Idaho, rates average $2.70 for outbound loads, up 15 cents a mile last week. And in flatbed, capacity predictably tight in the Pacific Northwest, lots of Christmas trees moving. around the country. Outbound Pacific Northwest flatbed rates averaged $2.42 a mile last week. That's up 17 cents a mile week over week. Some pretty good gains for carriers reported in Oregon, rates up to about $2.72. Outbound Portland spot rates sitting around 260, up a cent per mile. 1,200 mile loads to Denver averaging about 270. And wrapping up our market update with our year-over-year look at spot rates, after remaining flat for over 2 months, dry van line haul rates increased last week, up 6 cents a mile. At $1.63, rates are about 14 cents a mile lower than last year. And as you can see on the chart, about 4 cents a mile higher than in 2019. That's the lighter green coloured line. In refrigerated, rates edged back over $2 a mile for the first time in just over 3 months. Last week, they were up 3 cents a mile. At $2 a mile, the national average is about up 13 cents a mile in the last month and about 15 cents a mile lower than this time last year. And lastly, in flatbed, after decreasing by a penny per mile the prior week, flatbed rates bounced back by the same amount last week. They've been up and down a lot for the last few weeks. They're averaging about $1.88 per mile. That's 15 cents a mile lower than last year and sitting about 5 cents a mile higher than in 2019. If you want to find out more about what's happening in freight and get a copy of all of the charts and the commentary, we'll publish the long form version of today's market update this evening. Just go to dat.com/market update. Back to you, Ken, for the short terms.
All right, thanks, Dean. So these are our short-term forecasts. Much like last week, they're not going to be very interesting. When you're forecasting time series data like this, if you're doing it wisely, you have a seasonal component in the model, and this time of year, seasonality is so dominant that it makes for pretty boring model runs. So let's just level set on what this chart is. We always start with dry van. The blue line is historical data. It goes back to June here, I believe. It's a 7-day weighted moving average, excluding fuel, of long-haul dry van truckload rates. Then we have 4 forecast models. They're a little difficult to see here because they're so tightly aligned. But you've got raycast in green. That's our flagship model. You've got a red model, a red line, which is our short-term model. It more heavily weights near-term data. And then we have intermediate models that blend the long and short-term view in yellow and gray. I'm having a hard time even seeing it myself. And what you see here is pretty much exactly what happens at the end of every year. You're starting to see that end-of-year spike. Honestly, in most charts we display here at DAT, and dating back to my time in industry, I usually clip the first 1 to 2 and the last 1 to 2 weeks of the year off of my charts because it throws the scale and axis off because it spikes up so high. It really is just a mixture of out of service, high demand to get things shipped before the end of the year, and all of those things coming together. With the advent of e-commerce a while ago now, not that it's anything new, you tend to see that spill more over into January than typical. It's what we would call like a returns period. So the first 10 to 15 days of January will look very similar as well. Let's go to reefer. Again, almost identical models here. You do see this dip in reefer before the run up as things are warehoused from Thanksgiving, and then they start to pump back into the supply chain heading into perishable stuff for Christmas. And then flatbed, last but not least, it's less peaky, but you do still see it tail up towards the end of the year. The reason being there, you see a more pronounced out of service behavior with fleets. Weather tends to take capacity off the road. And again, anything that needs to ship, you want to get it off the dock before the end of the year so that you can get credit for that sale. So that's our short-term forecast for the week. I do think in the next 1 to 2 weeks, we will bring in the long terms just to end the year off right. So that will bring everyone back in for our question of the week.
Yeah, thanks, Ken. So, Ibrahim, with all the growth in commercial warehouse capacity this year, do you think 2024 will see a continuation, or will we see higher vacancy rates?
Well, so I mean, I think the short answer to that overall in aggregate is yes. I think vacancy rates are going to continue to rise next year. And the reason why I say that is because when you look at sort of the construction pipeline for warehousing, you can see how much is on the horizon. So, just to step back a little bit, when you think about like what it takes to build a warehouse, it usually takes about 4 or 5 quarters on average to deliver a warehouse once you break ground. And so what that means is like you can look at the current state of the number of projects that are underway, and you can get a pretty good estimate as to like how much new supply is going to hit the market over the next year. And so right now there's about 550 million square feet of warehouse capacity that's being built. And so you can figure like over the next 4 or 5 quarters, on average, you can expect to see about 100 to 125 million square feet of that hit every quarter, right? Now, that's the supply side. On the demand side, I just don't think the economic strength is there to cause sort of enough absorption to absorb all of that new space, right? You can have sort of debates as to whether or not the economy is going to fall into a recession or not. If you're on the freight side of the economy, I think it's been just a challenging period already. Regardless of how fast the economy overall is growing, the things that drive freight and goods have been considerably weaker. I suspect as you go into next year, there's probably going to be some improvement, but not enough to bring back sort of the really strong conditions that were there in 2021 and early 2022. And so what that means is that this space is going to be delivered, but there's not going to be enough expansion of warehousing plans by tenants to absorb it all. So like in aggregate, I think warehousing vacancies are going to continue to trend higher. Now, right now, for the sector, vacancy is around 5%. It's a little higher than 5% of the space is vacant. For some context, like historically on average, vacancy is around 6.9%. Right? So if you look back at like the last 30 years, on average is about 6.9% of industrial space that sits vacant. So we're still in like a very tight environment, but it's loosening pretty quickly. I think as you go through 2024, you'll start to see vacancy rates creep up closer to 6%. And so this is going to be a challenge throughout the year. Beyond 2024, however, I think you're going to start to see the supply pipeline die down quite a bit. And so again, like you can look at the existing construction pipeline and get a feel for how much is going to be delivered. There aren't a whole lot of new projects that are being broken where ground is being broken right now. It's tough to get financing for development now because of where interest rates are. And so what that means is like whenever this existing construction pipeline gets delivered, there's not going to be sort of more space to backfill it and beyond. So there's a supply challenge this year. As you go into 2025, there's probably going to be less supply that gets delivered then.
Is there a way to put into context what 550 million square feet looks like? Is there a way to describe the average warehouse compared to, say, an Amazon fulfillment center as a benchmark?
Well, it's a really good question. The easiest way is just to look at it as sort of like a percentage of the existing inventory that's out there, right? So 550 million square feet it's like 3.5% of all the existing warehousing that's already in existence, right? Now, historically, on average, like the amount that gets delivered in any given year is closer to like 2%, a little bit less than 2%. So this is still like what I would consider like an elevated construction pipeline. The pace of completions is still very high, quarter after quarter as the space gets delivered. You bring up a pretty interesting point as to like the kind of space that's being delivered. Like when you look at this, the kind of buildings that are being built, the vast majority of them are over 250,000 square feet. Right. And so there are a lot of spaces that are 250,000, 500,000, 1 million square feet, like these big bulk distribution kind of centers that are being built in areas that have the land for that kind of stuff to take place. So like the outskirts of cities, particularly like in the South and in the West, where there are some land that's available to build these kind of things. Like it's very difficult to build like 1 million square feet of industrial space in New Jersey or something like that, where land is expensive and it's just not available.
Right.
But I think the key takeaway when you look at sort of like what's being built is it's a lot of bulk space. And if you have like smaller space, things that are under 250,000 square feet, particularly if you're looking at things under 100,000 square feet, like these smaller last mile facilities, these fulfillment centers that are really only designed to carry a certain amount, there isn't a whole lot of new supply coming online, right? And so if you're in that environment, the space that's there is sort of what it's going to be. Like on average, they might deliver less than 1% of new supply every year.
Right.
And so that causes some pretty good disconnects in terms of like how the experience is. Like if you're in the market for leasing out this kind of space, then there's a chance that you have options to choose from. You have more leverage when trying to deal with rents. But for these kind of smaller last mile facilities, still very tight, and the rents are climbing still very quickly.
What are you seeing in the refrigerated? I mean, I don't know how much you kind of dabble in that area, but um, as it pertains to refrigerated warehousing and cross docking.
So refrigerated warehousing is part of a broader category of just like specialized warehousing space, right? Um, those spaces tend to have lower vacancies than overall. So number one, the tenants are a lot stickier. Once they're in, they tend to stay. They tend to stay there, and so it's not uncommon to find like vacancy trending a couple percentage points below like sector averages for sort of cold storage or refrigerated storage spaces. I would say that like a lot of the cold storage space that's out there is it's pretty old. Like a lot of the stuff was built in the 1940s and 1950s and 1960s. They typically require like more capital expenditures to maintain. But yeah, the vacancies are typically lower. Their tenants, once they're in, typically stay there, and the rent growth is typically a little bit stronger in these cold storage facilities.
Ibrahim, many years ago we were at a conference and you explained to a lot of trucking operators that GDP wasn't a good indicator of truckload demand for obvious reasons. But during the pandemic, we saw a big shift towards physical goods, less on services. Are we heading back in the other direction, as in an overcorrection to more spending on services as opposed to physical goods?
Well, certainly for the earlier parts of this year, I think that was sort of the case, that when you look at where consumers spend their money, 2021 was a year where it was predominantly being done on the good side of the economy, like it was buying new tangible things. 2022 and the early parts of 2023, I think you definitely saw the pendulum swing in the opposite direction, where there was an awful lot more spending on the service side of the economy. And this is part of the reason why I said, like in the beginning, that, like regardless of how well the economy has been doing this year, on the freight side, it really hasn't been nearly as great. I typically think of the things that drive freight and also warehousing demand as being tied to everything that involves like the movement of goods, right? And so you're looking at consumer spending on goods, particularly e-commerce, manufacturing activity, international trade on goods, housing activity, like these kind of things that deal with in physical goods. And most of those indicators are down year over year. I mean, consumer spending on goods, I think, is still pretty solid. It's not quite as strong as it is for services, but like the manufacturing sector isn't doing well. International trade is also down year over year. Housing activity in terms of home building is also down year over year. And so that's part of the reason why like this environment doesn't feel as great, even though like the broader economy is doing very well.
Are you tracking the change in imports as it relates to the ongoing drought conditions in the Panama Canal and what appears to be a shift of imports back to the West Coast?
Yes, absolutely. So the West Coast ports had a particularly tough sort of first half of this year, right? In part because of what's going on with the canal, but then also the labor negotiations with the port workers in the LA and Long Beach ports. And so when you got to, let's say, June or July, you saw big negative year over year TEU volumes in terms of what came into those ports. I think the past couple of months have been pretty encouraging that some of this volume is coming back. In the October data, like if you looked, it's just imported loaded containers coming into LA. It's up about 10% from where it was last year at the same time, right? And so I do think that there was a bit of an exaggerated reaction in the earlier part of this year. Again, part because of what was going on in the canal, the other part because of labor strikes. As you go forward, you'll see some normalization in terms of what's coming into the LA ports, and there's an awful lot of attention paid to the West Coast port strikes. Because it seems like every few years there's another labor dispute that comes out of LA and Long Beach. But the East Coast port workers, they also have a union. They also have contracts that they have to negotiate, and their contracts are up for negotiation next year. And so as you go into next year, to the extent that they're able to navigate that, you may see even more volume flow back to the West Coast ports.
I guess that was sort of a leading question into what markets are hot and what ones aren't, because during the 2021 period, we saw a lot of volume come into Houston and go up to Fort Worth. And that's sort of one of those evolving markets we talked about on the last show. But are there any other markets around the country that carriers and brokers should be thinking about in terms of, where we might see a change in volume, either higher or lower next year?
So I typically like border markets, the sort of the markets that are close to the border with Mexico. I mean, we've seen a lot of activity in terms of development and tenant activity, moving operations closer to the U.S.-Mexico border. So think about like the southern submarkets in San Diego, or some of the markets in Texas, like El Paso, that are very close to the U.S.-Mexico border. Those are very good. The other thing that I keep a very close eye on these days is just, areas where there are a lot of reshoring of production activity. It's if you were to look at, say, like census data on just the amount of money that people are spending on building new manufacturing plants, it's really surged this year. Like it's up about 60 or 70% year over year. And it's really just building of manufacturing plants that are close to, that are designed to bring production back. And so, some of this is tied to electric vehicles and the batteries and the parts that go into those. But there's an awful lot of this activity going on in the Southeast, especially the corridor between like Atlanta and Tennessee. You're seeing some just different kinds of electric vehicle plants or coming up. That drive some of it. And when these plants are up and operating, they're going to bring warehousing demand. They're also going to bring trucking activity along with them. The flip side of that, sort of the markets that aren't doing as well, there's a bit of a lagged effect between like what goes on in the ports of LA and what goes on in warehousing activity. And so you saw the port activity died down early part of this year. It's really shown up in the warehousing activity in Los Angeles. And some of the markets that are close to Los Angeles that feed off of that port activity. So like the Inland Empire in Riverside, they've seen just a significant amount of just negative net absorption. So more people moving out than moving in.
Would the same apply to like Phoenix and Denver markets that are, tangentially tied to the Los Angeles imports?
Well, to an extent, yes. I would say a market like Denver is a little bit more isolated than just sort of solely relying on LA imports. There's some of that effect as it kind of flows through the country, but Denver's a weird city. I mean, it sits and there aren't a whole lot of major metros that are around it either, and so a lot of the activity that's tied to Denver, the warehousing activity anyway, is tied to just economic activity that deals with Denver as it stands. I mean, Denver is a major metro. And so there's a lot of activity that drives that comes from that, but it does sit a little bit more isolated than some of these more coastal markets. Phoenix's big challenge, I think it's still a pretty desirable location for tenants, but there's a lot of supply coming online in Phoenix, and they also have they have challenges with just sort of how they scale their population and the activity around it because of some of the water restrictions that are tied to the Phoenix economy.
Yeah, that's a pretty big deal. The water problems that they've got there now, and some of the tunneling they're doing right now in the city to get more water in.
That's right.
Yeah. Any change in the technology that's going into, say, commercial distribution warehouses as it relates to automation?
Well, I mean, I think there's a longer term trend in general to try and make technological improvements, in part because one of the big challenges that you have with the warehousing, with where owning and operating a warehouse, is labor. Like it's oftentimes you find yourself competing in the same pool as a number of other industries that are looking for just like lower skilled or sort of less educated labor pool. And if you're in a city where unemployment's already low, or a market where unemployment is already low, it's very difficult to get to staff these warehouses. And so there's quite a bit of efforts made to just reduce the sort of the headcount that's needed in order to efficiently operate a warehouse. Right. I wouldn't say that there's been any kind of revolutionary thing that's occurred over the last year or anything, but I would say that it's just a general push on the warehousing side to bring more robotics into the warehouse, to bring more automation into the warehouse, to reduce the headcount necessary.
Do you have any sense of where some of the other macroeconomic indicators sit, like industrial production, manufacturing generates a lot of freight for truckers?
Well, it's a tough environment for the manufacturing sector. One, because like I mentioned earlier, like consumer spending on goods is okay, but it's not outstanding.
Right.
But the big problem is that like global growth isn't doing very well. There isn't that much demand for exports, for U.S. exports to the rest of the world. That drives a lot of industrial production also. And so you're just kind of seeing industrial production sort of trend sideways. Like in my view, it's when you look at the manufacturing sector, it's slightly negative, but it really just looks kind of flat this year. It certainly isn't sort of disastrous. There have been periods in recent memory that have been far worse for the manufacturing sector than where it sits now. But there also just isn't an awful lot of growth, and so you just kind of have activity that's sort of flatlined thus far this year. And again, I think as you look into 2024, there's probably going to be some improvement. I mean, again, there are these manufacturing plants that are being set up now that eventually will translate into actual output that's being produced. But I just don't see anything that's going to kickstart it into just like really robust growth like what we saw in 2021 in the early parts of 2022.
What sort of impact do you think interest rates will have on that point in terms of when growth might start?
Well, my view on interest rates is that where they go, it largely depends on how fast the economy grows. I mean, like if you look at sort of what's recent trends in interest rates, there was a big run up in interest rates like last month or so, and it was almost entirely driven by just the fact that like the economy kept growing stronger than everybody expected. And it made people believe that the Federal Reserve is going to have to keep interest rates higher for a longer period of time, or maybe hike rates further than where they currently are. And so my view is that like, as long as you're kind of on this pace where the economy gradually slows down, you're likely to see interest rates start to drift back towards like a longer term average rate of around 3.5% to 4%. But it largely hinges on how strong the economy does, how fast inflation comes back down, and things like that. As far as how it relates to influencing economic activity, I mean there are parts of the economy that are particularly sensitive to interest rates, right? And this is typically, when you think about the sectors that hinge on interest rates, you're looking at housing activity and durable goods, like large durable goods. Those kind of goods are typically very sensitive to just like movements in interest rates, because consumers have to finance these types of purchases. And so to the extent that interest rates stay high or end up higher than expected, they have an outsized effect on those sectors as opposed to some of the other sectors that are less sensitive.
Always learn something, Ibrahim. Thank you.
Quick question, Dean. Did you already read it? I don't think you did. From Matt Clark.
Yeah, no. Matt asks Ibrahim, what about Savannah? Since you're in Georgia, Savannah had negative vacancy rate. Matt asks, what is that running at currently, and what about next year for Savannah?
I'm not entirely sure what a negative vacancy rate would be, but I mean, I suspect this means that there's a sort of a slight negative absorption movement in Savannah. I mean, my general view is that Savannah over the long term is still going to be a pretty popular destination for tenants. The ports in Savannah have undergone like just tremendous efforts to expand the amount of capacity, with the idea of just like bringing more volume into those ports. And as that happens, you'll start to see just sort of a tenant activity that comes on the heels of that. Savannah also has a lot of space under construction at the moment. I mean, to put that into some perspective, about a sixth of all of the space that currently exists in Savannah, warehousing space, was delivered over the last year, right? And so, like, I mean, it's really exploding on the construction side of things. And so, as a result, you're starting to see vacancy trend up very quickly. But that's not atypical for these kind of markets that are beginning to gain attention from tenants and are expanding very quickly. There's a period between like when a space gets delivered and when you can find like a tenant to come in and lease it up that causes just vacancy rates to come up. I suspect as you go through this year that vacancy rates are going to continue to trend up. There's still a lot of space in the pipeline in Savannah. But in my view, it's still part of just like the broader expansion of the market as it becomes just a bigger deal in the industrial space.
Yeah, Savannah's sitting at about -8% volume year over year on the import side, and only just slightly ahead of 2018, 2019 levels. So that's, yeah, a lot of that warehouse development was related back to, I think it was 2020, 2022 was the big year for imports into Savannah.
That's right. That's sort of the broader story for U.S. imports in general. Like if you look at just total imports coming into the U.S., 2021, 2022 was a really huge period for just the amount of stuff that we were bringing in from other countries. As we've kind of moved away from that, you've seen some normalization on the import side of things, and so year over year, volumes are down at most ports,
right,
to varying degrees, and Savannah is no exception to that.
Right. All right, I think we're close on time. I don't think we've got any other questions, Ken.
Yeah, no, I think we're at time. We're gonna move it along here, I think.
All right, okay. I'll be on Rates and Lanes tonight with Chuck Snow and Rico Mohammed, 7 p.m. Eastern. Sales chatter tomorrow with Dan Deegan. As always, we're on Landline now, 7 p.m. on Sirius XM tomorrow night. On the latest edition of the podcast, Freight Vine, Chris Kaplan is talking to John Stauffer and Brian Crystal from Isometric Technologies about data and what on time means. On next week's show, we've got Zach Rogers talking about the Logistics Managers Index, the latest data for November. And with that, it's back to you, Ken, to wrap up the show.
Yeah, I want to thank Ibrahim for joining us this morning. I'll have to get you back in Q1 on the other side of the holidays to see how we fared over that time period. How can folks get in touch with you for your analysis or insight?
Can always reach out to me on LinkedIn. I typically connect within 24 hours for anybody that wants anything. I think that's the best way, and where you could find my email through there, and shoot me an email with a question directly.
Great. Dave Matheson, where's the Ohio State opening commentary? Asking for a friend. Well, I will say this, and I will only say this. As much as it sucks to lose, there's respect and honor in losing. There is no respect or honor in cheating. So the pain of losing is terrible, but I could not bear the shame of being a cheater. So if there are folks out there that are proud that your team won and cheated, then I say more power to you. But I'd rather lose fairly than win by cheating. Anyway, we will be here next Tuesday at 10 a.m. Eastern. I hope everyone gets caught back up after the holidays. I know I'm having a heck of a time digging out. And with all this snow and weather happening, I hope everyone stays safe out there as we're in the middle of this holiday rush. So thank you, and we will see you next week.